Welcome, dear students and scholars. Now we continue ASC 325, dear students and scholars. And this time we move from life settlement contracts into beneficial interests and securitized financial assets. This is where one pool of financial assets can create several different cash flow interests. Our job is to understand what the holder owns, how the interest is measured, how accretable yield works, and when an adverse cash flow change points us toward ASC 326 for credit loss analysis. This topic matters because securitized financial assets can look complicated very quickly. A pool of loans or receivables is transferred into a securitization vehicle. Different parties receive different rights to cash flows, and a retained or purchased interest becomes a separate financial asset. The key is to read the economics behind the structure, not just the legal label. In simple words, we follow the cash flows. The paperwork may wear a fancy suit, but the cash flows tell us what the accounting really needs. Here is the learning path for this video. First, we understand the securitization flow. Then we apply the ASC 325-40 scope rules. After that, we look at initial measurement for retained and purchased interest. Then we study expected cash flow updates, including favorable and adverse changes. Finally, we bridge to ASC 326 because when expected cash flows weaken, credit loss analysis becomes the next serious step. Securitization starts with a pool of financial assets, such as loans or receivables. Those assets move into a special purpose vehicle, and that vehicle issues interest to investors or leaves a retained interest with the transferor. Each holder must account for its own interest as a separate financial asset. The structure tells us who receives which cash flows, but it does not by itself decide the accounting. We still evaluate each interest based on its economic substance and the applicable ASC guidance. ASC 325-40 has two main entry points. The first is a transfer or retain interest in a securitization transaction that qualifies as a sale under ASC 860. ASC 860 decides whether the transfer is a sale. Once that sale treatment is established, ASC 325-40 helps account for the beneficial interest retained. The second entry point is a purchased beneficial interest, where a third party investor buys rights to cash flows from securitized financial assets. Not every interest in a securitized pool automatically enters ASC 325-40. The interest must be a debt security or accounted for like a debt security. The underlying securitized financial assets must have contractual cash flows, such as scheduled principal and interest. The holder must not consolidate the issuing entity, and the interest must not fall into the high credit quality exception that takes it out of this expected cash flow model. If the checklist fails, another topic such as ASC 320, ASC 321, ASC 323, or ASC 810 may control. This slide gives an important exam trap. Do not stop analysis just because the instrument is legally labeled equity. Some equity form interests can still be accounted for like debt securities if they represent only rights to future cash flows or have mandatory redemption features. But if the criteria are not met, the accounting may move elsewhere, such as equity method, debt securities, consolidation, or equity securities guidance. In accounting, labels are useful clues, but they are not the judge. The judge is economic substance. Initial measurement starts with the transaction type. If the transferor retains an interest after a securitization sale, the measurement connects back to ASC 860 and the fair value allocation at the transfer date. If an investor purchases a beneficial interest, the initial investment amount becomes the starting point, and the expected cash flow model determines accretable yield going forward. If the asset has credit deterioration since origination, purchased credit deteriorated guidance under ASC 326 may apply at initial recognition. Accretable yield is the core measurement concept in ASC 325-40. It is the difference between the expected cash flows and the initial investment. That difference is recognized as interest income over the life of the beneficial interest using the effective yield method. This is not simply the stated coupon on paper. The holder estimates what it expects to collect, and that expected collection pattern drives interest income. Timing matters, amount matters, and yes, the calculator will want your full attention here. At each reporting date, the holder updates expected cash flows using current conditions and reasonable supportable forecasts. If the update is favorable and expected collections still exceed the carrying amount, the accretable yield is adjusted prospectively. That means no immediate catch up gain and no retroactive restatement. If the update is adverse and expected collections fall below the carrying amount, the holder must evaluate credit loss guidance under ASC 326. So the cash flow update tells us whether we adjust yield or move into credit loss analysis. Now we introduce Northline Capital. It purchases a beneficial interest in 2026 for $80,000. At acquisition, expected cash flows are $104,000 over an expected life of 4 years. In 2027, expected cash flows are revised upward to $110,000. Later, in an adverse scenario, the present value of expected cash flows is estimated at $82,000. We will use these facts to calculate accretable yield, analyze a favorable change, and identify the credit loss bridge. At acquisition, Northline Capital expects to collect $104,000 and pays $80,000 for the beneficial interest. The accretable yield is therefore $24,000, calculated as $104,000 minus $80,000. That $24,000 is not recognized immediately. It is recognized over the expected life using the effective yield method. The carrying amount increases as yield is recognized and decreases as cash is collected. In 2027, expected cash flows improve from $104,000 to $110,000, an increase of $6,000. Because expected collections still exceed the carrying amount, this is treated as a change in estimate. The accretable yield is increased prospectively. That means future interest income changes, but prior periods are not restated, and no immediate gain is recorded just because the forecast improved. The rule is calm and practical. Better estimates adjust the path ahead. Now consider the adverse scenario. The carrying amount is $86,000, but the present value of updated expected cash flows is $82,000. That creates a $4,000 shortfall indicator. This does not automatically mean we record a loss on the spot, but it does mean we must evaluate credit loss guidance under ASC 326 for held to maturity and available for sale beneficial interests. The bridge matters because ASC 325 identifies the issue, while ASC 326 gives the deeper credit loss framework. Credit loss judgment requires discipline. Missed scheduled payments are evidence, but not automatic proof of credit loss. Receiving all payments to date is also not automatic proof that no credit loss exists. A fair value decline is not automatically a credit loss either, because fair value may reflect market rates, liquidity, or other factors. The proper conclusion comes from expected future cash flow evidence, current conditions, reasonable supportable forecasts, and professional judgment. In other words, do not let one data point boss around the entire analysis. This comparison slide is only a bridge, not a separate deep dive. Under IFRS 9, classification depends on the business model and whether cash flows are solely payments of principal and interest, which we say as SPPI. Under US GAAP, we use topic specific models, including ASC 320 for debt securities, ASC 310 for loans, ASC 321 for equity securities, and ASC 325 40 for beneficial interests. For SAP, insurers have specialized statutory investment guidance that may differ from US GAAP. The next major stop for credit losses is ASC 326. Now choose your answer. Which item is most likely within the scope of ASC 325 40? Option A is common stock with a readily determinable fair value. Option B is a purchase beneficial interest in securitized receivables with contractual cash flows where the holder does not consolidate the issuing entity. Option C is an investment giving significant influence. Option D is a consolidated subsidiary. Focus on the economic substance and the scope checklist, then lock your answer. The correct answer is B. A purchased beneficial interest in securitized receivables with contractual cash flows where the holder does not consolidate the issuer fits the ASC 325 40 scope logic. Option A points to ASC 321 because it is a common equity security. Option C points to ASC 323 because significant influence suggests the equity method. Option D points to ASC 810 because consolidation guidance overrides the beneficial interest model. Now apply the credit loss judgment idea. A holder has received all scheduled payments to date on a beneficial interest, but current forecasts show weaker future collections. What is the best conclusion? Option A says no credit loss analysis is needed because payments are current. Option B says every fair value decline is a credit loss. Option C says the holder should analyze expected future cash flows using current conditions and professional judgment. Option D says the asset must be reclassified as an equity security. Think forward, not only backward, and choose your answer now. The correct answer is C. Payment history is only one input. If current forecasts show weaker future collections, the holder must analyze expected future cash flows and apply professional judgment. Option A is wrong because receiving all scheduled payments to date does not eliminate future credit risk. Option B is wrong because fair value declines are not automatically credit losses. Option D is wrong because credit risk analysis does not change the instrument into an equity security. Classification and credit analysis are related, but they are not the same thing. Now work through the Northline Capital mini case. The initial investment is $80,000 and expected cash flows at purchase are $104,000. Later, the carrying amount is $86,000 while the present value of expected cash flows is $82,000. Your first task is to calculate the initial accretable yield. Your second task is to identify whether the later scenario creates a credit loss bridge and which ASC topic controls that deeper analysis. Take a moment and do both steps separately. Here is the clean reconciliation. Initial accretable yield equals $104,000 minus $80,000, which gives $24,000 recognized over 4 years using the effective yield method. Later, the carrying amount is $86,000 and the present value of expected cash flows is $82,000, creating a $4,000 potential shortfall. That shortfall is evaluated under ASC 326 credit loss guidance and is not automatically recognized without analysis. Thank you for studying ASC 325 with me. If this video made securitized interest clearer, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP. Next, we move into ASC 326 and build the full credit loss framework.